Hello again, and welcome everybody to the second part of the anti-bubble report. We're going to move on to discuss the portfolio, the performance, the attribution, and the rebalancing. And in that sense, October was yet another extraordinary month. We saw a very significant rebound in U.S. equities, in particular, perhaps the last leg of the melt up. Who knows? A lot of extraordinary things happening with Tesla and many other things, and a difficult period for defensive strategies. We see here the performance in blue of Igneo, in orange, in different other colors. U.S. equities, credit, emerging markets. And a concept that I will touch on in more detail later, this idea of false diversification and how during crisis, as volatility explodes, you could see correlations polarizing. And what we've seen recently is a continuation of this melt up where risk has been pretty much one way, although with a lot of red flags and more defensive stuff has been suffering. We finally have the taper. And that may be a turning point for the markets in terms of what it means as we head into an easing of the accommodation, although no interest rates or hikes in sight. Before we go into the portfolio, I think it's important, and this is critical to keep the big picture related to the previous discussion on. There are, in my view, two dimensions that are critical to build a portfolio. We must have a balanced team. I use this, you may recognize a football pitch or soccer pitch. We need in some ways strikers that will do well during benign markets. We need defenders and goalkeepers, and you also need midfielders. So I strongly recommend that people have balanced portfolios. The last 18 months has been one way. You would have done very well only with strikers, but certainly the time for defenders and goalkeepers might be ahead of us, and this is very cyclical. So taking profits on the strikers and building defenders is very sensible, in my opinion. But it's not just about the risk on, risk off, the long ball, short ball. It's also about inflation, and this is the other key driver that I think people must understand. And in that sense, not all strikers are the same, not all defenders are the same. And so if you think about the big losers, which I mark in red from a world of variation, they're clearly going to be cash, fixed income, and credit. These are the guys where your $100 or 100 euros in 10, 20, 30 years are going to buy you very, very little as inflation creeps up. On the other hand, equities might be benefited more, certainly, than credit, but real estate or anti-bubbles, I think, are much better positioned. So my recommendation is build a portfolio with these two dimensions. First one is risk on versus risk off, which is largely a volatility factor. And second, inflation. And in my opinion, you need a balanced risk and long inflation bias. To play that role, Igneo, as you well know, those who have been following or invested, it has three main components. We're big believers in gold. We'll talk about that later in more detail, which represents about 50% of the strategy across other precious metals. We have also a view and a position in U.S. Treasuries, which it might not be an anti-bubble, but it's certainly an anti-crisis. We'll talk about that later. And perhaps the more important part of the strategy, or the more volatile and punchy, is going to be the volatility. And in that sense, it's about 20% of the portfolio that is invested in options. And the key thing here is, you have two choices. You could either buy put options that protect you against the collapse of risk assets, or you could buy call options on anti-bubbles, such as gold or the VIX or inflation. And the puts would be on risk assets like equity, credit, or emerging markets or commodities. So with this, key thing is there's no direct leverage. You have your funded allocation, but obviously the options bucket could be very asymmetric and give a lot of convexity. The current positioning is around, as you can see here, I've bucketed the premium at risk, and what you see here is the breakdown per group, so gold and precious metals, S&P and VIX, and FX and rates, as well as by expiry or horizon. You see that the worst case scenario for these buckets is we lose the premium. And so there's about 2.4% of premium at risk for 2021. We've accumulated a more meaningful positioning for 2022, which currently is close to 10%. A very light position 2023, and then a bigger bucket in the long end, which contains views on rates and long-term volatility, for a total of about 21.2% in the portfolio. Key thing here is, multiple ways, not just systematic, but also fundamentally, where do we think what are going to be the good hedges? How do we position ourselves? And I would just highlight a few of them. We have a meaningful position in call options, basically long volatility, long inflation on gold, precious metals across different ways. We're quite long duration through a long-dated FX option, which is starting to be very interesting, extremely asymmetric. We are long the dollar as well through call options, and here we have the contrarian view of being long gold and long the dollar in a number of cases through correlation plays. So it requires both things to play out. We are pretty much by construction always try to be in some way exposed through equity or credit puts, effectively insurance against these risk markets collapsing. And we'll talk about that shortly. And very importantly, also, we think China, as we'll discuss later, it's a major tail risk, and we are positioned both through puts on the yuan and the Taiwan dollar. Fundamental that combines structural views as well as fundamentals, and in the implementation, the challenge here when you're buying insurance is balancing this idea of how much premium do I spend, how much carry, how much asymmetry, how much conviction. In the ideal scenarios, we have things that we have high conviction, i.e. we think that they have the potential to pay out significantly, but they're also cheap, they're asymmetric, and they carry very nicely. So whilst you wait, they're not costing much. Obviously, these things are extraordinarily difficult to find, and whilst our strong preference is always going to be buying vanilla options, we look for opportunities beyond that. We look into things like the skew or the term structure or correlation. And so as you can see here, we obviously prefer vanilla options to anything, provided volatility is very cheap. Unfortunately, the carry sometimes is tricky. We'll look at that into the VIX later. Exotic options are interesting because they allow us to basically, with one single asset, take advantage of other things more than just volatility, and create profiles that could be quite interesting by monetizing the skew, which we'll discuss in a minute. And also the hybrids combine two assets to take advantage on correlation, which the market, in my view, misprices on average terms, but they can be super explosive during crisis. So let's look at this also in terms of where do we stand. And what you can see is that we're currently slightly more aggressive at 21.2% in premium. We're above the 20% sort of neutral position. Part of this is because some of the options have been paying out lately. But the idea here is to have a balanced portfolio. You see how the breakdown per year, per sector, per type features. But obviously, we're looking at, very importantly, also for ways in which we control that premium. One of the big lessons learned for 2021 so far is, in markets that go on a complete straight line, and these options are effectively losing money, in order to retain that risk exposure, we've been obviously topping up. And this is something that, whilst it gives you a good risk profile, more constant, and you're ready for the goalkeeper, it's also potentially very painful if you don't have a single opportunity to shine. And so the portfolio will be rebalanced to try to take these levels. We continue to do that, but we do it subject to this 10% per annum of calendar year premium spent, which should give us sufficient room to do very well, because the average payout in our options is probably closer to 10-1 at the moment. So despite having 20%, this part could potentially pay if we let it run, 100 to 100%. So we'll talk about the rebalancing. It's been, as I said, something very relevant, perhaps less obvious in the strategy. And I've taken a case study, which is Q4, is March 2020 with COVID, and we saw how the strategy, a lot of things happen. But interesting, gold or treasuries actually had even problems then. But our starting position, our options book, actually did very well. But many things happened. Not everything worked. Some things made money, like treasuries. Some other parts lost money. Some of the options did very well, and we took profits and we reinvested. Some other things did badly and expired. And every time we invest, we look into this new on a forward-looking basis. So taking profits on the VIX allowed us to accumulate, for example, valuable insurance on gold or others, and this is very dynamic. So ultimately, what you see is that when these big events happen and the dust settles, you're looking to be in a new stable position that is sort of balanced back to our weightings, which is close to neutral. So the idea is to have a strategy that will be, as predictable as possible, do what it says in the tin, that has a risk reduction process on the way up, but also will increase risk when things go against you. So we're accumulating on the conviction. And this is, again, painful in a period like the last 18 months, but important in our opinion to be able to do what we need to do and want to do when more hostile markets come. And this is a very repeatable process where we're constantly looking for asymmetry of payoff as well as conviction. And we do this with daily liquidity and that. So with that, I finish the second part. I will be moving to the third section to talk about the relative value across the other assets shortly. Thank you very much for your support, and speak soon. Thank you.